Hey everyone, it's Imran from Options Insight, back with another macro options spotlight.
Remember, like, subscribe, comment, ask questions. We want to get this stuff passed around so more people learn about options.
Okay, so if we look at what's going on in stocks, US looking a bit shaky at the back end of last week. After OPEC support was rolling off, market couldn't hold on to that 4,100 level and broke down. Looking pretty weak again overnight, down to that 40.50, testing the 40.50 area. And it looks like a test of 4,000 is kind of on the cards here. Europe did outperform. More inflows coming back into Europe, as Bank of America point out. And then China was also weak. Generally, that narrative of the China reopening kind of stalling a bit, looking for more stimulus out of China to really confirm things are happening there. Commodity-wise, they also had a rough week, apart from copper, which managed to stage a bit of a bounce off $4 that we've been saying that was the big level to hold. But the likes of gold, silver, oil, nat gas, uranium, everything taking a bit of a hit. But nothing too dramatic. We're talking about half to 1 sigma type down moves on the week. Gold does look like it's still headed to 1,800. And energy does look relatively bidless right now, especially nat gas that's just been getting crushed and broke below that $2.50 level that we were looking at. Vols did start to bounce from the midweek lows that they reached after the CPI vol reset that we've been talking about. So they did finish the week down. You can see one to two vols in US indices, but that was off the lows. The VIX popping back above 20, around 21, as we did see some relentless call buying coming in on the VIX. Obviously, those monster clips in March that went up a week or two ago have been followed up with some big clips in June and also in July. So it does seem that the street is getting taken out of convexity in the VIX, in the upside. If the VIX was to kind of go through those mid-20 levels towards 30, then we could get a bit of action there, as the street would be quite massively short vol via that VIX complex. Metals vol was lower on the week, and then energy vol slightly better bid, as obviously downside hedging looks like it may well be warranted because some of these charts are not looking too great. In terms of carry, positive carry back across most of the stock indices. Obviously some decent carry here in Europe, especially with both FTSE and Nikkei providing the highest percentages in terms of carry. And they also happen to be the lowest in absolute vol terms, which is, some people think that's counterintuitive, that you're going to get the best short gammers are the ones with the lowest absolute vols. But that is often how it works in volatility land, where, the reason they're trading at such low vols is because no one wants to own them and the things just don't realize. And then positive carry back in metals, precious metals here, a lot of green there, as whilst we have been heading towards those key supports in gold, the velocity of the sell-off does seem to be slowing down. So maybe the sell-off is getting quite close to exhaustion, and that backs up the idea that maybe we want to flip from short to long gold if we do get into that 1,800 area. And then finally, skew did hold up much better than implied vol last week. These skew levels are kind of back into the 30th percentiles. Remember, a month or two ago, we were looking at single-digit percentiles on these things. So whilst at the money vol did drop on the vol reset on the week, skew held up much, much better. And that's because there seems to be this demand for downside as investors have got longs to protect, and yet they're getting a bit more nervous about the macro, about what yields are doing, and about what the Fed potentially is going to do with rates, or not going to do, let's say, as a pivot gets priced out of markets. Or at least a pivot gets priced out of market this year. Okay, moving on. Some of the charts I'm looking at. So we've got retail and CTAs have been the big buyers. So we've got these Vanda research guys who put out what's going on in the retail space in terms of inflows into US equities. And they said that retail in January were buying $1.5 billion per day, which is the highest ever recorded. So clearly there was a lot of retail capitulation at the back end of last year, tax loss selling, things like that. They completely turned around. And we saw a massive spike in inflows come from retail in January that's really helping drive the rally. And you see that here in this red line spiking up to the highs. And that does explain why, some of these most shorted meme stock type names and crypto also have been really outperforming so far this year. Whilst they were the worst performers last year, they've been the best performers so far this year. And then along with retail, we've got the systematic crowd, the CTAs, that we obviously often go on about. They've been adding length. They've got their length back up to quite high levels. If we look back historically, 74th percentile. They've been chasing that stronger price momentum of markets, but to the point where they look quite vulnerable now. So if markets were to trade down, go back below that 4,000 level on S&P, there's quite a large amount of selling that needs to be done from the CTA community, and that could very much exacerbate any weakness. So there's some fragility building there in that these price insensitive sellers, if we do start to sell off, are just going to start puking this stuff that they've bought, and that could really push the move on the downside. And then add to that the fact that you've got a street, a dealer community that looks like it's been taken out of downside options via the fact that the skew's gone bid, then that's a recipe for potentially a vol spike on its way, and more likely than maybe we were 3 or 4 months ago. Okay, then if we look at our strategy compass, so we've thrown in the compass for the different assets here, just to kind of give a quick summary of what we're seeing. In terms of stocks, obviously we've seen US pull back a bit, so kind of middle range here, but you've still got European puts looking the most attractive to buy. It's got DAX, FTSE, Eurostox, all of those, because spot is still relatively elevated and vol is relatively cheap. So in terms of the cheap puts out there, you'd be looking at European equities. In terms of commodities, we are generally in buy call territory. So all of these commodities kind of screening as potential call buying candidates. Nat gas maybe not so much because the vol's a bit more mid-range. But, we've been talking about potentially buying some gold calls as we get into that support zone. But it's kind of true for most of these. Copper did obviously have a bit of a bounce. So spot-wise, copper's not looking quite as cheap as it was. And even that, the volatility levels on copper are nowhere near as cheap as, say, the likes of gold. So maybe you look at call spreads there if you wanted to. Bonds, obviously, they're in the buy call spread type territory. We wouldn't really be comfortable in selling puts in bonds right now, given what's going on in terms of the inflation picture and how the market's kind of repricing that outlook on inflation a little bit. So probably call spreads, as we've been talking about on TOT, still look like the favored trade to us. But even HYG has taken a bit of a whack recently, right? So if you opportunistically wanted to play a bounce in HYG, those calls or call spreads look pretty good in terms of the absolute vol levels are quite low there. So that would give you leverage to that type of move. And then in sectors, finally, we've got most of the vols looking quite cheap, except for ARC, which is up here, a bit more mid-rangey. And XLE in particular is looking like the buy call candidate, because that's been beaten up in terms of spot and the vols at the lower end of the range. So if you did want to buy the dip in XLE, and I still think it might have some more downside personally, looking at the chart, but it's one of those that is starting to look interesting from a call buying perspective as well, looking at our strategy compass. Okay, so that's the summary for what we're seeing if you're looking for, what option strategies make sense. We'll finish up with the VIX. So the VIX Beta is rising. So remember, the VIX Beta is one of the metrics that we look at. We just look at the kind of regression between what the S&P movement is and what the VIX futures movement is. And we want to get a sense for how that thing is correlating and how that thing is moving. So this chart, the VIX Beta signal, showed that got very, very low in absolute terms. That got to sub 1, early this year. We have seen that turn pretty violently. So the VIX Beta is now above 2 or above -2, so less than -2. And we compare that to the 3-month, which is the white line, and we've seen it slash through there. So you're seeing the momentum there of the VIX Beta increasing, which is saying that the VIX is becoming more sensitive to S&P moves than it has been in quite some time. So that gives us a bit of a sense of what's going on there under the hood on VIX. And how dealers might be positioned in terms of vol and vol of vol. So we're starting to see that movement, and that can often be a precursor to a more meaningful volatility spike. If we look at the flows, they to some extent explain that as well, because you've seen this big build up in call open interest, from 25 up to, say, 40 strikes in the various expiries, obviously March being the one with the most stuff going on. We've got those big pillars coming in June. We've also got a big clip of these in May as well. So a lot of upside being bought by clients, dealers getting taken short that upside convexity. If the VIX was to start to go higher, then there'd be a fair amount of vol expansion and vega that those dealers would need to buy, which would potentially drive even more upside in the VIX. So something to be aware of. And for us, we just see these developments as the foundations being laid for a more material vol spike, similar to maybe this type of thing we saw in September, October last year. Obviously in the summer into August, we had that big rally. And then when the markets repriced, we got the vol going back into the 30s, right? So we're not saying we necessarily go to 40, 50 vol or whatever in the VIX, but we are seeing a pickup in skew. We are seeing dealer positioning look like they're getting taken short upside on the VIX. They're getting taken short downside on the S&P. And we're starting to see the VIX being more responsive to moves in the S&P. So these are all little telltale signs that fragility is building. And if spot wants to go below 4,000, there may well be some fireworks. All right. So that's kind of the takeaway from today. Thanks a lot for listening as always, and I'll catch you guys tomorrow. Cheers.